1089. One day, I will have a post-acquisition loss, but I keep on getting post-acquisition profits. And that's good. That's normal. That is 65 and 89, so that is 1, 5, 4. So my post-acquisition profits are 154. Time out for a sec. At the year end, I'm actually an 80-20% scenario because I'm buying 20% more shares. So shall I split this? How much of this profit goes to the NCI? Shall I take 40% or 20%? What did you do? What did you do when you did the question? Did you take 40 or did you take 20? Then you were correct. Don't let me try and fool you. Don't let me try and fool you. Yeah? You know, this is because the transaction happened at the year end. So for the 12-month period, the relationship has been 60-40. All right? So you're looking at these profits for the whole 12 months, and for those 12 months, the profits have been 60-40. It's only on the very last day there's a change. I've never seen this, I've never seen this, I've never seen this. But let's imagine the change in the NCI occurred halfway through the year. If the change occurred halfway through the year, your post-acquisition profits would still be 154. But for the first 6 months, the split would be 60-40, and then for the second 6 months, the split will be 80-20. Does that make sense? But in order for the examiner to try and keep things neat, he always conveniently, to date, shows the changes in the NCI occurring on the very last day of the year. Yeah? And that just makes life a little bit neater, makes it a little bit easier. But conceptually, it wouldn't be a leap if he'd put it in the middle, it would just be a little bit fiddly. Yeah? And if that comes up, you'll remember Sunday morning. So that's the amount going to the NCI. It's a fairly straightforward scenario. The amount going to other components of equity is 11, so this must be here 143. 143. So 60% of that will go to retained earnings, and 60% of that will go to other components of equity, and that is working 6, and that is working 5. I'm moving on to the calculation of goodwill, ASAP, as soon as possible. Number 4, working 3 is my goodwill, and my goodwill is data. And I want the fair value of the parent's investment, and there is no controversy. The fair value of the parent's investment in data is 820. That's what it says in the question. No, there is controversy. Is it 820 or is it 600? 600, yeah, it's 600 because the 220 is the reduction in the NCI payment. So at the date of acquisition a year ago, I paid 600. You've got the NCI, which is using the full goodwill method, which is based on the share price, and the fair value of the NCI is 395, which means goodwill will be in full. And then the fair value of the net assets at the date of acquisition is 935. So this is going to give us a goodwill figure. The goodwill figure is 60. The goodwill figure is 60. That is full goodwill. I'm anticipating, because I've had a sneak at note number 3, that there will be an impairment loss. That impairment loss will then be split, because it is full goodwill. You have NCI at fair value, so you've got full goodwill. So there will be a split, and that split again, I'm assuming will be done on a 60-40 basis. 60% 40% basis. Goodwill was impairment tested after the additional acquisition. Okay. No, top of page 46. Goodwill was impairment tested after the additional acquisition. So perhaps it won't be split 60-40. Perhaps it will be split 80-20. Yeah? Because both events are happening at the year end, and what happens first? I don't know. So I just double checked, and funnily enough, the question told me that the impairment test is done afterwards. Yeah? So therefore, any impairment loss that we have will be split 80-20, and this will give us our goodwill at the year end. Devil sometimes in the detail. It's not the end of the world if you do 60-40. I'm moving on to do some posting. Yeah, I'm moving on to do some posting. So I have here my NCI, and I have an opening balance of NCI in respect of data, and I know that to be 395. You must write this. Plus share post act. You must write plus share post act. You must show a small working, and the split is 60-40, so in the NCI it's 40% of 154, and 40% of 154 is 61.5. 61.6. Leave a space, leave lots of space, give it a bit of respect. Working 5, retained earnings. You start with the parent company, and that is 1,066. And then you must write share of post act. Reference it. It has been 60%. 60% of what? Back to working 2. And in working 2, we've got 60% of 143. 60% of 143 is 85.8. Excellent. Leave lots of space. Working 6. And this is your other components of equity. And you start off with that of your parent company. And your parent company has other components of equity of 60. And then you must write this plus share of post AC. And this is for data. And so this is 60%. And then you go back to working 2. And in working 2, it's 60% of 11. So 60% of 11 is 6.6, I would imagine. Have I finished? Yes and no. There's still something to do because we have a further 20% interest in data. So here we are, back I go, here we are, back I go. Yeah, I have a, what I hope you all agree, is a control to control transaction where we reduce the NCI, and therefore there will be a difference that goes to reserves. Now the cash that is being paid is 220. There is so much theory going on here, it is not true. At 60% I have control. If I buy another 20%, I will still have control. Yeah? So therefore this is it was a sub, it remains a sub. There is no change to the goodwill. I am the parent, I am transacting with my NCI, and my NCI is going down. You cannot make a profit from the parent transacting with the NCI, because the NCI is part of group equity, it's part of the group family, so therefore there is no profit or loss. What you have is a difference, and you could be asked to explain this. Here, we're just being asked to do it. Is this cash coming in or going out? It's going out. This is the debit balance that you are cancelling. This is the investment that we have made. We are buying 20%. If we were buying 40%, the whole of the NCI would be eliminated. If we were buying 40%, the whole of the NCI would be eliminated. But I'm only buying effectively half of the NCI. So I have a decrease in the NCI balance. I am buying 20/40ths of that NCI balance. When did the transaction take place? At the year end. So I want to know what the balance of the NCI is at the year end. If the transaction had taken place 6 months ago, then obviously it would be 40% of 154 times 6/12. But I haven't done that. Yeah? I know what the NCI balance is. It's not happening at the first day of the year. It's happening at the end of the year. So at the end of the year, the amount of the NCI balance is 4. Tell me you did this. 395 plus 61 gives me 456. So that is a subtotal of the NCI balance at the date of the transfer. And half of that is disappearing. So the reduction in the NCI is 20/40ths of that 456.6, which is 228.3. Yeah, which is 228.3. Not only is it 228.3, yeah, here, because you are reducing the NCI, so if you like, that is your debit, but it's also, yeah, 228.3 here as well. And that is effectively your credit. So we've got the working appearing twice. So I've already posted my working 4. I've already posted the reduction in the NCI. I therefore have a difference that will go directly to equity. I will have a difference that will go to other components of equity, and that difference is 8.3. Every question has a trade. Now that we've got the difference of 8.3, is that making you feel happy or sad? Happy, yeah, because you've only paid 20, but you've got rid of a problem of 28. Or you can see, effectively, you've got a net credit balance. This is positive. So the 8.3 is positive. So you've got a difference here that is going to reserves, which is positive. And that difference that goes to reserves is positive. Back I go, back I go. Here we are, the references from working 7. The references from working 7. This is 8.3, and this is our control to control difference. I'm pausing for a second. Yeah, I'm pausing for a second. It is this little working that I have already successfully posted, and I am just about to move on to the second subsidiary. I know there's an impairment review to do, but I'll do that at the end. I'm going to move on to the second subsidiary now of captive. Before I do that, yeah? So far so good? So far so good. Right, okay. Right, so here we are. We're now looking at the second subsidiary, and there is an opening paragraph. And on the 1st of December 2010, Traveller buys 80% of captive. So this is an 80% relationship, therefore we have a 20% NCI. And it was bought on the 1st of December 2010, so in the context, this is 2 years ago. and the consideration is 541. Check. Yeah, the consideration is 541. Check. And it is 541 here. Check. The consideration comprises cash of 477 and land with a fair value of 64. So if I take those two numbers and I add them together, just to double check, 477 plus 64 is 541. So I'm going around in circles. I have paid 541. Bit unusual giving up some land, but you know, when I come to calculate goodwill, 541 is the real deal. The carrying value of the land at the date of acquisition was 56. Yeah. Is it 2 years or 1 year? I don't know. Oh, it's 1 year, isn't it? Thank you. That's a very gentle way of asking a question when you know that I'm wrong and you are right. Oh, sir, do you think? That's fine. Thank you. Thank you. Thank you. So, yeah, looking at the story here, we've got some horrible story about the land, which I'm not really comfortable with, but I know that the investment is the right number. The carrying value of the land is 56, and yet the land has a fair value of 64, and the land is included in the non-current assets of Traveller, and the sale proceeds have been credited to profit and loss. It's just horrible. At the date of acquisition, it had a fair value of 526, the net assets are 526, retained earnings are 90, other components are 24, and the excess in the fair value is due to land, a bit deja vu there, seen that before, and we're using the partial goodwill method. So we're using NCI as a proportion of net assets. Well, what do? Do I fret? Do I worry about that stupid land business? No, I don't think so. I get on with the question, and therefore I am now looking at my next working, which is effectively, what was my last number? Working 7. So I'm now looking at my net asset. Let me do what I can do. Yeah? Let me do what I can do, and then we'll come back and have a look at that weird thing later. So acquisition, year-end, post. So the subsidiary has 390, 169, 45, and these numbers can go in very quickly. And then I start looking for what they were at the date of acquisition. And the retained earnings were 90, and the other components of equity were 24. And then we've got a fair value of the net assets at the date of acquisition of 526. There does not appear to be a provisional valuation to change that number. So therefore, we are looking at a fair value adjustment on land as the balancing figure. I have done that quickly. This fair value adjustment has got nothing to do with the land that we've transferred. So it's 390 plus 90 plus 24 does not come to 526. It'll be a number ending in 2. 22. I'm assuming the land is still there, so I take the land across. If the land has been sold, this figure would be nil. If the land has disappeared, if the asset has been sold, then this figure would be nil. But it is not sold, it is still there. If it was plant, I would have additional depreciation. And then it would be really important whether I knew the sub had been there for 1 year or 2 years. Yeah? Because would it be 1 year's depreciation or 2 years depreciation? It depends. Yeah, but that is not there. If there was a deferred tax implication, you'd have to bring in a deferred tax liability here and here, but it's not there. So I shouldn't worry about it too much. Hopefully somebody can tell me what these numbers add up to.